Zach, so good to see you. I wanted to talk through 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of uncertainty and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I'd like to start with this chart. What stands out to you here about how the market responds to global events?
Yeah, so what stands out to me the most is how resilient the market has been over looking past the 70, 80 years. A lot of big events has happened, from oil embargoes, Black Monday, global financial crisis, you name it. Big volatility events happen in the short term, but over the long run, if we zoom out, we can see that that trend only gets higher, and that's due to innovation that happens on the company side. They learn how to adapt to those different market conditions, such as the high inflation in the 70s. So it seems that the market always finds a way to put in higher highs over the long run.
Does seem that way, right? Like you're saying. So when I zoom out, it's easy to see why the best advice is often stay invested, stay the course. But if I feel uncomfortable about how I'm invested, when is the right time to make changes to my portfolio?
Yeah, so normally the worst time to make changes to the portfolio is during those volatile events.
Yeah.
Something that we work with our clients is it's an ongoing discussion every year. How are you managing the risk? How do you feel during those volatile moments? If you're losing sleep over, a 10% drawdown in the market, that might be something that we need to reevaluate, that we have too much risk in the portfolio that you're not comfortable with.
Hmm.
Oftentimes when we're making changes inside of a portfolio, at baseline, it's normally when life changes happen. So
Yeah.
income needs change, risk tolerance needs change, like can't sleep at night, income needs change. Whatever that, idea or plan is that you have on your end that needs to be changed, we need to do that in calmer markets. And that's why it's
Mhm.
an ongoing discussion every year,
Right,
not
right.
during those volatile moments.
And I know you specialize in helping people who are in that retirement red zone. So how does the answer change for someone who is nearing retirement or recently retired?
Absolutely. And I think that I could speak for every advisor in the office. That's probably one of our most favorite things, is getting somebody pre-retiree into retirement and how that changes in terms of a portfolio structure.
Mhm,
So
mhm.
you've had the luxury of being able to weather that volatility over 30, 40 years of growth. But as we're inching closer and closer to retirement, it might be time to start shaving off some of those profits in the safety buckets. So that way you don't have to worry about what the market is doing.
Right. And specifically because retiring into a down market presents a very unique challenge known as sequence risk. Can you explain this for us, please?
Yeah, so sequent risk just really refers to the danger of experiencing poor market returns early in retirement. And I love showcasing this figure that we have here to clients during a meeting of, you have two investors. One investor, or I should say, they both have the same returns over the long run, same starting value. One investor, though, experiences a bad market cycle late in retirement. The one over on the right side experiences worse market cycle in the beginning of retirement. So if we're experiencing that in the beginning of retirement while taking withdrawals out of the portfolio, we're just having to make that much more in the later years to help
Right,
get us back to break even. So
right.
this really, falls into how do we start getting out of equities that carried us for the past 30, 40 years of growth into more safety vehicles, so we don't have to worry about what the market's doing.
Right. And I want to drill down into that a little bit more because, of course, we have no control over what the market is doing when we want to retire. So, how do you guard against sequence risk?
Yeah, so there's a few different strategies that can be deployed, but kind of the most common that we tend to use with clients is kind of a bucket strategy. So I really love this visual here as well. You have your safety, income, and growth. Like I said, those growth portion of the bucket has carried you for 30 to 40 years, but we want to try and mitigate as much sequence of returns risk that we can. So
Hmm.
basically the idea is to start shaving off some of those profits in the growth bucket about 5 years at the earliest, out of the growth bucket into a more safe vehicle. Maybe it's a money market, maybe it's an annuity, whatever the case may be. You have a stable source there that you can take income out of, and you don't have to worry about what that growth bucket is doing. The next is kind of a more medium term, that income bucket there. This might be dividend stocks, less volatile than growth stocks. It may be a bond ladder, whatever the case may be there. That would cover you from years 3 to 7 in retirement. So have these bucket strategies here for your short-term retirement, your short-term reserve of 1 to 2 years of expenses built up, your medium-term bucket or the income bucket, 3 to 7 years, and then the growth bucket for that long-term growth.
Right. And then that growth bucket allows us to participate in the gains over the long run.
Absolutely. And it's going to be our best hedge against inflation too over the long run.
Yeah. I'm so glad you brought that up. It was really, valuable to talk this through with you, Zach. And I think what I've learned from it is if I feel uncomfortable about how I'm invested, the time I should have had that conversation with somebody was yesterday. So if somebody would like to sit down with you, create that plan, make sure that they are not at risk of sequence risk, what's the best way to reach you?
Yeah, they could call our office at 614-430-8383, or they can visit us on our website at www.young-wm.com.
Great. Zach, thank you.
Thanks, Aaron.